Hello traders, in this lesson I want to talk to you about the importance of trading with Confluence. Firstly, let me take a moment to explain what Confluence is. In a nutshell, Confluence, when it applies to trading, is simply combining more than one trading technique or analysis to increase your odds of a winning trade. So in other words, it means having more than one factor present before you enter the market. For example, entering the market based just upon a signal alone is not enough. To give your trade decision more weight, you need more than just either a buy or sell signal. The more evidence you have, the more factors that support that signal means you are entering the market based upon confluence. To be successful as a foreign exchange trader, you need to have an edge, as you know, that enables you to make a consistent profit. An edge that will allow you to earn enough money when you are winning and lose less than your winnings when you end up with a losing trade on your hands. Trading with Confluence gives you the increased edge that you need to succeed in the Forex market. A technical confluence occurs when you find a trade setup using multiple technical analysis. And when all these independent forms of analysis come together, you have put yourself in a very high probability situation to determine the future track of the market. Now, there are many ways that a trader can apply the concept of confluence to their trading. For me personally, I look for 5 confluent factors to aid my trading decision. So let's look at the minimum 3 factors that need to be present before I enter the market. So if you do nothing else, traders, I want to encourage you to look for these 3 confluent factors before you yourself enter the market. Now, of course, if you had more than these 3 factors, then that's a bonus, and we'll discuss the other confluent factors in a moment. But in my view, these 3 factors must be present or I don't enter. And they are trend, level, and signal. Now, we all know, if you've been trading for more than a day, you know the easiest, most reliable way to make money is to trade in the direction of the underlying trend. So the very first thing we do is determine the trend. Now, whilst this video is my tutorial on how to do that, on how to determine the trend, you do need to ask yourself, what is the long-term trend of the market? Long-term being 1 year or more. So you simply zoom out of your charts and look at the higher time frames. Look at the weekly time frame to get an overall macro view of the historical movement of the market. If you see price has been trending for a year or more in either direction, then straight up, you know at some point you would be looking to enter the market in alignment with the underlying trend. Of course, if you are unsure how to determine the trend of the market, then this is where you are at your stage of trading. And as we all know, this is the very first skill that you need to master. So let's assume you know how to determine the trend of the market. What we want to do next is to simply identify the key event areas on your charts. Event areas are represented by previous support or resistance levels, or more accurately, support or resistance areas or zones on your charts. These areas on your charts are where price has repeatedly revisited and reacted from these areas. Again, if you don't know how to correctly identify support and resistance zones, I've created a video on how to identify these areas perfectly every single time. So if this is your weakness, make sure you watch that training video. But once again, assuming you know how to determine the trend and you have marked your major support and resistance zones on your charts, all you do now is wait for your price action buy or sell signal to form at or around these key event areas. Once again, I created a training video called Why You Need to Be a Specialist, where I go into detail why you should master just one price action strategy at a time. So make sure you go and check that video out. But in short, you should only enter the market on a price action signal that you know how to trade intimately, as opposed to entering the market on every price action signal that you'll be able to come across. So if you're trading in the direction of the underlying trend, if your price action signal has formed at either static horizontal support or resistance or dynamic support or resistance, then in most cases that's about as good as you're going to get, and you should enter the market confidently and without hesitation, because you have the three biddies all lining up to telling you to enter the market. Now, if the trade fails, it has nothing to do with your analysis. It is simply a result of the random distribution of winners and losers. So assuming we had these three factors, which is enough, by the way, what else can we look for to see if there is anything else of relevance to give our decision to enter the market more weight? Well, there are a couple more. The first is using the only indicator I believe you need to use, which is the EMAs, the exponential moving averages. And once again, I have a training video called the correct use of the EMAs. So if you don't know how to correctly use the power of moving averages, then you need to check that video out as well. But in essence, if your price action signal, be it a reverse signal or a continuation signal, forms at a horizontal support or resistance area and is also showing rejection or support where it reacts or respects dynamic support or resistance, being the EMAs, then you have another confluent factor telling you that price once again is respecting the mean, meaning price has revisited an area where it's comfortable, and the EMAs are a moving average which tells you an area or price point where price has repeatedly reacted from. Now traders, just a tip on EMAs. The time horizon and the style of your own trading are decisive for selecting the right moving average. For those who hold trades for longer and don't want to be pushed out of the market due to the initial smaller correctional movements, typically choose a higher number of periods for their moving average. However, for those who are day traders who tend to react quickly to price fluctuations and want to enter and exit the market many times per day, they are better off with a shorter number of periods. So if you're a day trader, for example, the 8 to 10 periods are very popular because the moving averages react quickly to price. And if you are a swing trader with a longer term view and strategic thinking is important, often the 21 or the 50 period moving averages work very well as they are used as a support and resistance tool. So I will look to see how price is interacting with the moving averages. If price has shown a previous pattern of respecting the moving averages and then retracing back into the zone of the moving averages before taking off again in line with the trend, then I will see if my price action signal has formed after retracing back into the EMAs in line with the trend. Then that is a strong confluent factor because it becomes a self-fulfilling prophecy. If millions of traders are using these standard period moving averages, they strengthen the impact of those moving averages. The fifth most relevant confluent factor I look for is for a Fibonacci retracement. Once again, I have a training on how to use the Fibonacci retracement, but more specifically, I only use the one setting, and that is the 50% area. I know the 61.8 retracement is considered the golden number. However, I have found that price often retraces into the 50% area of a previous significant move. And if I have a price action buy or sell signal that has formed in line with the trend and at a static or dynamic support or resistance area, I will then overlay my Fibonacci retracement tool to see if my price action signal has also formed around the 50% retracement level. If it has, then once again, I have another factor in my favor to add weight to my decision to enter the market. Now, of course, it's a rare day indeed when you'll have all these 5 confluent factors present at the same time. And indeed, if that is the case, then obviously that's gold. You are compelled to take the trade. But as I said before, as long as you have the top 3, trend, level and signal, then you are trading with confluence and you know that you have entered the market with a high probability price action setup. So there you have it, guys. They are my top 5 confluent factors that I look for before I enter the market. And I encourage you to take the time to ensure that you have at least the top 3 factors present before you take your next trade. And if you do that before you take every other trade from this point on, you will find your ratio between winning and losing trades change dramatically. Traders, I hope you have found this video helpful. Until next time, happy trading. Bye for now.